An example. Consider the case of Michael, a German national working for a US investment bank in London. Michael is paid in sterling but has assets and liabilities in a number of currencies. He has US dollar denominated share options which he can liquidate in 9 months' time. He also holds cash balances in Australian dollars from a previous employment in Australia. He makes frequent payments in euros to service a euro mortgage for a property he owns in Germany. He plans to pay off the mortgage when he moves back to Germany in 2 years. In addition to the German property, he also owns property in London. Recently, he reviewed his overall assets to work out his currency exposure and found it to be weighted as follows: 60% US dollar, 20% sterling, 15% Australian dollar, and 5% euro. As the majority of his assets are weighted towards the US dollar, he has reviewed how the US dollar has performed over the last 5 years against sterling, the Australian dollar, and the euro, and found it to be extremely volatile. By way of an example of how volatile this has been, take a look at the graph which shows how the US dollar and euro have performed over a 5-year period. Between 2008 and mid-2011, performance was particularly volatile, and at the highest point, the euro was worth 1.60 US dollars. However, at the lowest point, the euro was worth only 1.19 US dollars, a difference of 41 US cents in the space of 3 years. Let's return to the example of Michael and look at what he can do to minimise his exchange rate risk. After speaking with one of our currency specialists, as well as doing some research of his own, Michael may decide to reduce his exposure to the US and Australian dollar, whilst increasing his exposure to the euro. He can do this in a number of ways. Here's 2 possible ideas. Firstly, he could convert some of his Australian dollars to euros in the spot market. Why would he do this? Well, he no longer has a need for Australian dollars, but he does have a future need for euros. He may also believe that the spot rate being offered is favourable. Secondly, he could book a forward contract to convert US dollars to euro for delivery shortly after he is able to liquidate his US dollar denominated share options in 9 months' time. Michael feels that the US dollar may weaken in value against the euro, and so by booking a forward contract, he can secure his foreign exchange rate no matter what happens with the US dollar to euro rate over the next 9 months. Well, how can you manage your FX exposure? There are a number of things you can do, and here are 6 ideas. 1. Be informed. Identify which currencies you're exposed to and work out what your exposure looks like. 2. Know how to access information about the FX markets. For example, by reading the FX tutorials on our website. 3. Consider products that can help reduce FX exposure, including spot transactions, fixed forwards, and option-dated forwards. 4. Diversification. Important if you are concerned about being overexposed to one or more currencies. Holding a mixture of currencies can smooth out the effects of volatility over a longer period of time and therefore help diversify a portfolio of assets. 5. Hold accounts in your core currencies, which can reduce the number of times you need to trade. For example, if you're making regular payments to countries in the Eurozone, open a Euro account. And finally, 6. Request a debit or credit card in other currencies. For example, a US dollar card assigned to a US dollar current account to make payments when travelling within the USA. To find out more about how Barclays Wealth can help you with your foreign exchange needs, please don't hesitate to contact us. Simply call or email us using the details shown on the screen. If you're unsure as to whether our FX services are suitable for you, you should of course seek independent financial advice. To watch further videos on currency topics, visit www.barclayswealth.com/FX tutorials. We look forward to hearing from you.